Good afternoon, and welcome to the webinar hosted by the IRC Institute and ISS on its latest report, Controlled Companies in the S&P 1500, a follow-up review of performance and risk. Our agenda today is introductions, an in-depth review of the research, words from the IRC Institute on its perspective on the findings, and then we'll take your questions. In terms of webinar logistics for today, all of the attendees are in listen-only mode, but we do encourage your questions. If you notice on your control panel, there's a drop-down box for questions. Throughout the presentation, feel free to type any questions you have into the question box. After the presenters have run through the findings, we'll read those questions aloud and we'll respond to them. You will receive an email following this presentation with a link to a replay of this session, which is being recorded, as well as a link to a PDF of this PowerPoint presentation. All of that information, as well as the full report, are available at www.irrcinstitute.org. And if you would like to share information on social media, we encourage you to do that. Our Twitter handles are listed there. And if you have any audio issues during the session, feel free to contact GoToMeeting at 1-800-263-6317. We have two speakers today. The first one is Edward Camanjo, co-author of the study. Edward is the head of U.S. Strategic Research Analysis and Studies at ISS. Edward has over a decade of experience and expertise working with institutional investors to assess their investment policies and evaluate whether investor philosophies comport with underlying mandates and risk management objectives. Previously, he headed ESG's research at ISS, as well as ISS's specialty research offerings that cater to the needs of Taft-Hartley and public fund institutional investors, as well as SRI and faith-based investors. Our second speaker is John Lekumnik. He is Executive Director of the IRC Institute. He served in this role since IRC was established. Along with the board, he has led the organization to become a leading source of objective academic and practitioner research on investment issues so that investors, policymakers, and other stakeholders can make data-driven decisions. John has decades of experience on investor issues, including serving as the investment advisor to the New York City pension funds. Just a few words about the IRC Institute if you're not familiar with the organization. It's a nonprofit that was established in 2005 and is headquartered in New York City. And essentially what the organization does is it funds and disseminates that objective, unbiased research on a whole range of investor issues, everything from environmental issues, corporate governance, CEO pay, a broad range of issues. And it's, again, both academic and practitioner research. The Institute also funds an annual research award with two $10,000 prizes that was given out recently. You can check that out if you're interested in applying for future award applications. And all of the research is available on the website at no charge. We have a new website that's got a much more user-friendly search functionality, so you can just type in keywords and find what you're looking for. And with that, I will turn it over to Edward for a few words about ISS and then a deep dive into the research. Edward?
Thank you, Kelly. I think many on the call are probably familiar with ISS, but I'll provide a brief overview for those that may not be as familiar with us. I think in addition to what you see up on the slide, I'd just like to highlight that ISS has a 30-year track record of experience and leadership in corporate governance. Over this 30-year period, ISS has evolved to become a one-stop shop for corporate governance and responsible investment solutions globally, including data and analytics that drive investment decision-making processes, including through responsible investment research coverage for more than 13,000 companies globally. For more information about ISS and our solutions for investment managers, asset owners, hedge funds, and other professionals, investment professionals, I would invite you to visit our website, issgovernance.com. And with that intro, I think we can launch into the study's findings, starting off with a brief background of the study, which is a sequel to one that ISS conducted in 2012. On behalf of the IRRC Institute. I think, so the universe of companies in this study comprised firms in the S&P 1500 as of the end of July 2015. We identified 105 controlled companies and found that approximately 3/4 of controlled companies have multiple classes of stock with enhanced voting rights. This compares to 69% of firms in the 2012 study and represents a 5 percentage point increase in the proportion of controlled multi-class stock companies over this 3-year period. As in the 2012 study, our definition of a controlling party includes any person or group that controls at least 30% of a company's voting power or that has the ability to elect a substantial number of board members. Let's now jump to the next slide for a summary of the study's findings. The first finding I'll highlight is that we found that the number of controlled companies fell by approximately 8% between 2012 and 2015. Secondly, as referenced in the previous slide, and for reasons we'll discuss later, the preferred mode of retaining control by company founders or their families is through multiple classes of stock with unequal voting rights. Third, let's run quickly through some of the key findings of the study, which are that controlled companies are getting bigger. In fact, they've just about doubled in size. Controlled companies generally underperform on financial metrics affecting unaffiliated shareholders. They have fewer women, minorities, and financial experts on their boards, and they feature the most tenured and least refreshed boardrooms. And finally, controlled company boards are predisposed to paying their CEOs substantially more than their peers at non-controlled firms. And we'll drill down into each of these findings during the course of this presentation. The next slide spotlights some additional high-level findings. While we found that the volume of controlled firms dropped by about 8% in the last 3 years, we also did find that the number of controlled companies in the S&P 1500 index increased by 16.7% over the 10-year period between 2005 and 2015. However, this increase does represent a slowdown from a growth rate of about 31% in the 10-year period between 2002 and 2012 that was covered by the first controlled company study. I'd previously mentioned that about 3/4 of controlled firms in the S&P 1500 index have multi-class stock structures. Well, the first graphic on this slide breaks down the various control types even further. We see that multiple classes of stock with enhanced voting rights for director elections are the preferred control mechanism, followed by control by way of multi-class super voting stock, which typically features 10 votes a share, but could be supersized to as many as 80 votes a share, or even mega-sized to upwards of 3 million votes per share. Companies with a single class of stock represent the minority of controlled firms. The second graphic on the slide shows that nearly 70% of controlled companies cluster in 3 sectors, that is the consumer discretionary, industrials, and consumer staples sectors. Majority of the firms in the consumer discretionary sector belong to the media industry, more than half of which is controlled. In the next slide, we highlight that the finding that controlled companies with multi-class capital structures are the ultimate survivors. Only firms with multiple classes of stock established their controlling mechanisms prior to 1960, and firms in this category became controlled before 1990. The average age of controlled companies featuring multi-class stock structures is 31 years, or more than double the 15-year average of controlled firms with a single class of stock. In sharp contrast, single-class stock-controlled companies are not born with similar survival instincts. I think over half of these firms became controlled after the year 2000, compared with less than a fifth of multi-class stock-controlled firms. And almost 3 times as many entities with single-class stock became controlled after 2010 relative to those companies with class stock structures. In this next slide, it basically illustrates the significant growth in the size of controlled companies, which have cast a wider shadow on investors' portfolios, thereby increasing their market exposure to the risks associated with controlled entities, which I think John will touch on in a little while. Our study found that over the 10-year period between 2005 and 2015, controlled companies have essentially doubled their market capitalization, excuse me, on both an average and a median basis. I think to cast this growth burst a little differently, controlled companies represented 10% of the total market capitalization of S&P 500 firms in 2015, which is up from 5% in 2005. And if these double every 10 years growth rates persist going forward, investors have even more reason to be concerned. The next slide highlights that while controlled companies are built to survive, there is no guarantee that they shall thrive. Controlled companies underperformed their non-controlled counterparts over all study periods reviewed, that is 1, 3, 5, and 10-year periods, with respect to average shareholder returns, revenue growth, return on equity, and dividend payouts. That being said, controlled companies did manage to outperform non-controlled firms with respect to the return on assets measure. The results for returns on invested capital were mixed. Controlled companies outperformed marginally by less than a percentage point for most time periods, but underperformed over the 10-year period. Similar observations were made for EBITDA growth, where controlled companies outperformed non-controlled company growth rates for the 5 and 10-year periods, but underperformed over the shorter time frames. Performance on balance sheet metrics such as liquidity ratios was also mixed. I should note that the 10-year period metrics suffixed with an asterisk represent metrics where companies with outlier values that skewed the averages were excluded. More details on the outliers are available in the full study. If we could just touch on TSR for a minute, given that many investors have shown a lot of interest in this metric, I'd just like to point out that our study dissected TSR performance across controlled companies in the aggregate, as well as by those controlled via multiple classes of stock, as well as a single class of stock relative to non-controlled firms. What we found was that while TSR performance is time period dependent, there does not appear to be any empirical evidence for the controlled companies outperform theory. And in this next slide, we see that while metrics on volatility are somewhat mixed, average volatility at controlled firms is higher than that of non-controlled companies over the 1 and 10-year periods, and lower than that of non-controlled firms over the 3 and 5-year periods. Furthermore, controlled companies with single-class stock structures generally show lower average volatility than both controlled firms with multiple classes of stock and non-controlled firms across all periods reviewed with the exception of the 10-year period. Next slide. In the next few slides, we'll review findings related to board attributes, including diversity, tenure, refreshment, and expertise. And these are all topics at the top of many investor agendas. Let's start off with board diversity. Our study found that women and minority directors are less prevalent at controlled companies. Specifically, the proportion of controlled firms with 0 women on the board is almost 4 percentage points higher than at non-controlled firms. And the percentage of companies with 2 women on the board is 9 percentage points lower. Further, the prevalence of controlled firms with no minority representation on the board is 20 percentage points higher than that of non-controlled companies, and the proportion of firms with 2 minorities on the board is lower by more than 7 percentage points. Let's now move on to the next slide on board tenure. I should first mention that we define extended tenure as at least 15 years of board service and long tenure as 10 or more years of service on the board. And so that said, we can move on to highlighting some of our findings. First, our study observed that the proportion of controlled companies where board members average at least 15 years of service is upwards of 17 percentage points higher than at non-controlled companies. And when we looked beyond the averages by slicing the data by the proportion of boards with prolonged director tenure, even more of a divide was uncovered. So if we focus on the graphic on the upper left side for a moment, we can see that more than a fifth of controlled companies have at least half the board filled by directors with 15 or more years of service, which is a rate of almost 3 times higher than at non-controlled firms. We note similar trends across other percent of board thresholds examined. We see that controlled companies consistently feature a much higher proportion of boards with extended tenures than non-controlled companies. If we shift focus to the graphic on the lower right-hand side, we see that almost 50% of controlled companies have half their boards filled by directors with at least 10 years of service, and just shy of 80% of controlled companies have at least a quarter of the board occupied by directors with long tenures. I think in conclusion, long director tenures and low board turnover rates have often been cited as reasons for the glacial pace at which women and minorities are appointed to boards, and the finding that controlled companies have lower levels of ethnic diversity should come as no surprise given the long director tenure at these firms. Shifting gears now in the next slide which discusses topic of board refreshment. I think to begin with, I'll highlight that we examined refreshment through the lens of the proportion of new directors on the board, that is, those with 0 years of tenure, as well as by the percentage of recently nominated board members who have between 1 to 3 years of board service. If we focus on the graph on the upper left for a moment, we see that with respect to new nominees, almost 80% of controlled companies have no new nominees on their board, which is almost 10 percentage points higher than at non-controlled companies. And where non-controlled companies have some new blood on the board, they bring fewer types of new blood to the table relative to non-controlled companies across all the new nominee percent of board thresholds examined. If we shift focus to the graph on the lower right, we can see that the proportion of controlled companies with recent nominees is still lower than that at non-controlled companies. For example, the percentage of controlled companies with no recent board members is 10 percentage points higher than that of non-controlled companies. Similarly, we noted a consistently lower proportion of controlled companies with recently appointed board members across the other thresholds examined relative to non-controlled companies. Next slide, please. In addition to lacking fresh blood, controlled company boards also appear to be anemic on financially savvy directors, but they have a healthy supply of executive officer board members. Controlled companies essentially have the lowest proportion of firms with the highest percentage of financial experts on the board and the highest proportion of firms with the lowest percentage of financial experts on the board. Shifting focus to the upper left graph, we see that the proportion of controlled companies with less than 10% of directors with financial expertise on the board is almost 5 percentage points higher than at non-controlled firms. And the prevalence of controlled companies with at least 30% of financial experts on the board is more than 11 percentage points lower. If we move over to the graphic on the lower right, which depicts the professional experience of board members at controlled versus non-controlled companies, we see a higher prevalence of board seats at controlled firms occupied by individuals whose professional experience is as executive officers versus that at non-controlled firms. Conversely, at non-controlled companies, retired professionals represent a higher prevalence of directorships than at controlled entities. And now on to the topic of executive pay. Average CEO pay at controlled companies with a multi-class capital structure is substantially higher than CEO pay at both single-class stock-controlled firms and non-controlled companies. This significant pay differential at multi-class stock firms is really largely attributable to disproportionately high CEO pay at media companies. It's also worth noting that controlled firms with a single class of stock actually pay their CEOs less than half the broader market average, or some $3.9 million less. In the study itself, we did break down executive pay by large cap, mid cap, and small cap companies, and found that much of the pay differential between controlled and non-controlled companies stems from high executive pay at the large cap firms. Next, let's review the findings of a comparative analysis of the governance features at controlled versus non-controlled companies. The graph in this slide is divided into three sections, and I'll discuss each in turn. On the leftmost section of the graph, we can see that controlled companies have significantly lower levels of board independence and a substantially lower prevalence of a majority vote standard that facilitates democratic board elections. If we shift now to the middle portion of the graph, while it seems like controlled companies afford more rights to their shareholders with respect to the ability to act by written consent or the right to call a special meeting, the higher prevalence of these rights actually favor the controlling parties, who can invoke them to act quickly and unilaterally between annual shareholder meetings. These rights would offer more protection to unaffiliated shareholders at non-controlled companies as a potential check on entrenchment between annual general meetings. And if you focus on the rightmost part of the graph, it should come as no surprise that controlled companies have fewer traditional defenses than non-controlled firms. The need for additional defenses is obviated by the controlling party's already considerable influence over the outcome of corporate actions requiring a shareholder vote. Let's move on to the next slide, which summarizes the findings of our survey of institutional investors. 114 investors representing almost 110 organizations globally responded to the survey. Almost 2/3 of those surveyed provided their perspectives with respect to controlled companies, and a majority of those that weighed in indicated that they do make distinctions between controlled and non-controlled companies when making investment or proxy voting decisions. These distinctions made at controlled companies amount to greater scrutiny of topics including board independence and board composition, executive compensation, takeover defenses and minority shareholder rights, related party dealings, and stock ownership requirements. What we heard amongst several investors was that directors at controlled companies are more likely to be entrenched, and that control through majority ownership was less problematic than control through super voting shares, because the former ensures an alignment of economic interests, whereas the latter does not. And I think the next slide, if we want to move on to the next slide, this slide highlights the findings of our examination of recently public firms to assess whether controlled companies are on the rise in this universe or not. What we basically found was that the number of controlled recently public firms has indeed gone up. The 2012 study found 48 recently IPO'd controlled companies between the period covering January 2010 through the end of March in 2012, whereas the 2016 study found 110 recently IPO'd companies from the period April 2012 to October 2015. Now, let me place these findings in appropriate context. While the number of controlled companies has more than doubled over these two time periods reviewed, in percentage terms, their prevalence has actually inched downward by almost 5 percentage points, and this drop is largely attributable to the decrease in the proportion of firms that went public with a multi-class stock structure. But while the prevalence of controlled companies has dipped, the median market capitalization of recently public controlled firms is more than 2 times, is actually 2.2 times that of non-controlled recently public firms. And this finding is similar to that which we touched on earlier with respect to the median market cap for controlled companies in the S&P 1500 index being twice that of non-controlled firms in the index. Again, it comes as no surprise that controlled company governance practices and provisions, including levels of board independence, the prevalence of material weaknesses, and the ability of controlling shareholders to act unilaterally, all largely disfavor minority shareholders. In my concluding remarks, I'd like to leave you with a Cliff Notes version of the findings of our study, which are basically that while controlled companies are still a minority, representing just 7% of S&P 1500 constituents and 10% of the index's market cap, they are built to survive and are getting bigger. They are likely to underperform their peers. Their boards are loaded with financially unsophisticated, long-tenured Caucasian male directors who tend to overpay their CEOs. Their shareholders view them with suspicion, and for good reason. And they've been breeding like rabbits over the last few years, and their newborns still retain their predecessors' signature features. And with that, I'll turn it over to John.
Thank you, Edward. I don't know how I follow that conclusory statement, but I will try. First off, I do want to say this is an incredibly comprehensive and detailed report. As Edward took you on the brief tour, you can see that it covers the nature of the universe, performance across a variety of characteristics, from TSR to balance sheet metrics to financial metrics to revenue growth to whatever. And it divides all that out often by not just control versus non-control, but single-class control, multi-class control, non-control, sometimes by sector, sometimes by market capitalization. It deals with governance features. It deals with executive compensation, and obviously it deals with market participant views. So I do encourage you to download the study, which is available for free at ircinstitute.org, because it's worth diving into and finding which aspects of this study relate specifically to your investment programs. What I'd like to focus on today, though, is the multi-class share-controlled companies. And for a very simple reason, that's where the controversy is. That's why Alibaba had to shop for a forum for a listing. That's last week the Council of Institutional Investors called basically for the end of multi-class IPOs. There is a perception among opponents that A, it's just not fair to have governance and control rights disproportionate to your capital at risk. But there's also an equally fervently held belief among proponents that such control structures allow boards and managements to somewhat mitigate the short-term pressures of the marketplace and focus on long-term value creation in a way that the proponents would say everyone wins. Next slide, please. So the question is, who's right? And as Edward said, I think we'll get to that in a second. But I want to say one thing. What is clear before we even get to the performance thing is multi-class companies are built not for performance. They're built for comfort. Their boards are materially less independent. That means insiders don't have pesky independent directors asking uncomfortable questions. The boards are very long tenured. Again, you have a comfort level with your board. You stay. You're not risking new people asking why you're doing things the same old way. They are not diverse. Diversity is not comfortable. It's important. The whole point of diversity is to have different and challenging viewpoints. If you're not diverse, you are at risk of having much more groupthink. Groupthink is comfortable. I don't know if it's healthy. And you pay your insiders more, which makes everybody much more comfortable. So I think it's clear that multi-class companies are built for comfort, which does bring us to the performance question. Next slide, please. These numbers are going to be a little different than Edward's because Edward had all single class and multi-class in there. This is just multi-class numbers. I think it is fair to say that performance is corporate specific and time specific. There is no evidence to support the proponents' contention that dual class or multi-class shares companies have a structural advantage. In neither this study nor the 2012 study has that borne out in any way, shape, or form. In the 2012 study, in fact, it was a little more obvious that they underperformed. In this study, it is clear that they generally, but not always, underperform. What does that mean? Well, TSR is sort of mixed, but they underperform in 2 of the 4 periods. Revenue growth, they underperform all the time. ROE, they underperform all the time. ROIC, they actually outperform in 3 of the 4 time periods. So if you were an academic and you were testing a null set theory, you would say, okay, theory not proven. And I think that's where we come out here, that it is corporate specific and time period specific, and there's no particular difference in volatility as a measure of risk. Next slide. So the question then is, why are people upset? First, as I said, there's the issue of fairness that people perceive. But I think there's another issue. If they generally outperform, what happens when things go wrong? When things go wrong, the traditional remedies are not available, and as Edward just detailed with the written consent and ability to act between meetings, in fact, some of the governance mitigations when things go wrong are stacked against you. So effectively, multi-class control companies contain different and arguably more contingent risk for external investors. You can't get in and fix it when things go wrong. So the key is, will you get paid for taking that risk? That calls for real fundamental analysis of both the control structure and the controlling entity. Is it a skilled, benevolent dictator, in effect, where you can capital allocate, move quickly, benefit everybody, or an insulated entity with little at risk? What the study seems to suggest is it's neither one nor the other, it's both, and in general, you cannot rely on it being a skilled, benevolent dictator. Next slide, please. With that, I will turn it over. So my conclusion is these companies are built for comfort, not for performance. As we all react differently, some people work well under comfortable situations, and some people work well under stressful situations. So too with companies. And the problem here is when there is a problem, it's hard to fix it. With that, let me turn it back over to Kelly, and we'll be glad to entertain questions. Thank you.
Thanks, John and Edward. We're now on to the Q&A portion of the webinar. So as a reminder, excuse me, if you have a question, just type it in that question box. There's a pull down on your control panel, and we will read the question aloud, and either John or Edward will respond to it. Excuse me. Our first question in the queue is, does your definition differentiate between controlled companies based meeting ownership rules and companies that elect in their proxy to take advantage of the exemption?
I can take a stab at that one, Kelly. I think whereas our definition of controlled companies included, the definition of controlled stipulated by both regulation and exchange listing standards. We did not, in our study, dissect the data on which controlled companies had taken advantage of the exemptions and which ones had not. I think we did note in the study that some of them had chosen not to avail themselves of the exemptions offered. But I think it's worth pointing out that our definition of controlled companies includes those companies with an individual or parties that control 30% or more of a company's voting power. So the study went further than, if you will, the legal definition of what constitutes a controlled company.
Thank you. Our next question, did your study find any recent successful attempts by shareholders to convince companies to move from multi-class to single-class stock structures?
I think we did look at shareholder efforts to collapse multi-class stock structures, and this is primarily through shareholder resolutions asking for basically one share, one vote principle. What we found was that these efforts have largely not been successful. Most of those proposals have not fared well. What was an interesting finding, however, was that the attempts have increased in recent years. So I think we looked at data going back to the year 2000, and we found that 30% of all the proposals asking companies to get rid of their dual-class structure took place. Let me see if I remember the facts correctly. Took place in the last 2 years, so 2014 and 2015. And if we look back to 2012, at the volume of proposals that shareholders voted on, 60% of those proposals took place in 2014 and 2015. So it looks like there's an uptick in inactivity by shareholders to push companies towards collapsing their multi-class stock structures.
Thank you. Our next question, are these differences being discussed all statistically significant?
I don't think we did like a regression analysis or what have you. I think we just looked at the data and we reported what it said, but I don't think we looked at statistical significance as some academic papers have done on other topics.
Our next question, you might have touched on this a little bit. Director pay, any differences noted at controlled companies?
We focused on executive pay, not so much director pay, but that may be a subject for an interesting subject for further review down the road.
Thank you. The next question, can you expand on the issue of material weakness prevalence in controlled versus non-controlled recent IPOs?
Let me see if I can quickly find that slide, guys. We don't already have it up there.
I can move back to it.
I think what we found, I think it's the one more slide.
Is that it?
Right. Yes. So I think what we found in the 2015 study, even looking beyond IPOs at firms in the S&P 1500, that we didn't find any prevalence of material weaknesses in that universe of firms. And it seems that even with recently IPO'd controlled firms, the prevalence of material weaknesses has dropped from 2012. As you can see there's a differential of almost 4 percentage points. So in terms of commenting on that, it looks like directionally the prevalence of material weaknesses has gone down, both in the S&P 1500 and at newly IPO'd companies. I hope that answers the question.
Thank you. Our next question. Did you look at the correlation between performance and CEO pay? That is, was the best performing controlled company that paid their, was it the best performing controlled companies that paid their CEOs the most, or was there a disconnect?
I don't think we looked at that correlation per se. No, we didn't look at the data that way, but I think what we were trying to accomplish here was not to look at the statistics from a company-by-company basis, but rather look at things at a much higher level across all controlled companies.
Also, if I could just chime in, if the question sort of is, well, maybe the higher pay was justified because it went to higher performing companies, I would start with what Edward said, which is we're looking across the universe. But since performance for all controlled companies was not better than performance for non-controlled companies, and performance for multi-class companies was not better for, because the difference in pay is in the multi-class component of the controlled company. So the multi-class performers were not better performing than controlled corporations. In the aggregate, you wouldn't think there would be any justification based on performance for multi-class controlled companies to pay more based on a performance reason, because multi-class companies did not perform better.
We have another question. I think you addressed all of it, but I'll ask it just in case you have more comments. Were the executive compensation findings adjusted for company size, performance, and other independent factors that might affect compensation?
The company, they were, I know, Edward, please chime in, they were bucketed by capitalization size, which is the largest component in every executive comp study. This wasn't an exec comp study, it was a controlled corporation study, so one could easily do more normalization. But in fact, when you were comparing buckets to buckets of capitalization, the disproportionate pay was concentrated in the large cap, mega cap sector, not in mid cap or small caps.
And then we have a comment, if you want to chime in on this. I've seen that almost 50% of concern over the last few years' warnings are at IPO companies. I don't know if you have any thoughts on that. More of a comment. And it looks like we have just a couple more questions. Can you drill down as to what's underlying the 8% dip in controlled companies since 2012? Is it fewer such IPOs relative to previous periods, a number of controlled firms being acquired or merged out?
I think we did try and look at what led to that drop, and I think what we found was primarily as a result of firms, being acquired or through mergers, M&A activity was a primary reason. Another reason was firms dropping out of the S&P 1500 index, and given that the focus of the study was at S&P 1500 companies, I guess if the question also touched on IPOs, I think it did, then assuming those IPOs were not part of the 1500, then no, I think that drop was not because of fewer IPOs.
And our next question, beyond the Council of Institutional Investor policies mentioned earlier, what are shareholders doing to address concerns over controlled companies, and has it been effective?
John, I can touch on this briefly, but feel free to jump in. I think I'll just point to the investor survey that we did, and what we heard from investors was that they're scrutinizing companies control companies a lot more in terms of board composition, executive pay, shareholder rights, and what have you. And I think this is public, so we can discuss it. T. Rowe Price, which is a well-known asset manager, recently came out and said that they plan to vote against key members of the board at U.S. firms with dual-class capital structures. So that's a flavor, somewhat of a flavor of what some investors are doing or thinking about as it pertains to controlled companies. But John, if you have anything to add, please go ahead.
No, I mean, part of the problem here is it is very difficult to do anything about it. Proposals seeking to collapse structures generally only succeed if management and the controlling shareholder support them. So it is clear that there is frustration. There have been 35 shareholder proposals which came to a vote in the last 3 years to eliminate multi-class structures. One of them passed, Steward Information Services. That was a question earlier. And in that case, the board didn't issue a recommendation for or against. They wanted to legitimately hear what the shareholder base thought, and then ultimately elected to collapse the shares into a single class. So it is clear that there is investor dissatisfaction. Whether investors can be successful in translating that dissatisfaction into some sort of actual action to collapse multi-class shares is a much more open question.
Thank you. That concludes the question and answer period. We've appreciate all those great questions, and we also appreciate your attention today. If you have any follow-up questions, our contacts from the webinar are listed here for John and Edward. And just as a reminder, we will send out an email tomorrow with a link to this PowerPoint presentation and a replay of this session. And of course, if you have any other follow-up questions, just be sure to give us a call and we'd be happy to respond. So again, thank you for your attention, and we hope you have a wonderful afternoon. This concludes the webinar.